Hi, everybody. Welcome to Westchester Talk Radio. I'm Bob Marone. Today, another encounter with our friends at Hightower. With us this morning, Roman Chosik. He is the managing director and partner at Hightower, and we will be talking today about long-term care and life insurance. Good morning. How are you, sir?
I am doing well, Bob. Nice to see you. As always, thank you for having us on, and it's good to see you're well.
Well, we're going to get right to business, and so let's do that. From speaking with you and your colleagues of these last few years, I know your practice focuses on giving clients a holistic approach. One of the areas that is a top of mind to clients is insurance, be it life insurance or long-term care. It is certainly critical in the planning process. Can you give us some insight as to how your team utilizes insurance?
Yeah, thanks, Bob. So, first of all, our team, as I sort of mentioned, is that we're holistic in nature. So we really look at financial planning as the starting and end point as well. And for us, it's about looking at your entire financial picture, your assets, liabilities, and utilizing life insurance as a primary vehicle certainly helps in the planning process. Ultimately, for us, it's about preserving our clients' wealth. It's about looking at estate planning, and it's about mitigating some of that liability that may be occurred without having insurance. Ultimately, our plan is to really mitigate some of that risk to the insurance company, and therefore we do use a lot of insurance in the planning process.
One of the areas that has gotten a lot of interest is long-term care, particularly with people living so long now. Can you talk about that?
Yeah, definitely a hot topic, and certainly something of interest to everybody. And if there's a single unsolved problem in the retirement plans for many middle and upper middle income adults, it's what to do about long-term care costs later in life. And this is a meaningful conversation that we really have with the overall family. The question that many of our clients ask, or ones that we ask of them, is who is ultimately going to take care of you? Is it going to be family? Are you going to be going into some form of facility? Are you going to have home health care? Are your kids going to be taking care of you? After that discussion, we ultimately kind of come back to a point of what is the best for the family. And to us, we come back with saying it's about having options. And that's where ultimately the conversation goes. And for those that have been through the process of long-term care, whether it's their parents or their significant others, they understand the importance of this long-term care part. I mean, we start this conversation relatively earlier in the process when someone is about 50 years old. And usually we do it as a couple because historically the female part of the relationship, if you will, they tend to be historically the caregiver as far as in the relationship. So they understand the impact of this, and a lot of the burden unfortunately falls on them. So it's a qualitative sort of discussion point, and we sort of have to come to a middle ground, because the reality is that 1 out of every 2 individuals over the age of 65 will need some form of care. So again, it's critical. And the last part I'll just mention is the fact that fast forward 20 years from now, we're looking at the population increasing by another 20% or so of people over the age of 65, which again falls under that whole idea of who's going to take care of these individuals. We're looking at these staggering numbers of over 71 million people.
Wow. Well, let's talk about then insurance for this. When should someone consider long-term care insurance?
Yeah.
And why?
Yeah, certainly. The obvious reason for that is, as many of you know, it's expensive. It's very expensive, and it's dependent on where an individual may live. And just to give everybody an example, in New York, you're looking for a private facility per year of somewhere around $120,000. So the average stay, give or take, is about 2.5 years. Do the math on that. It's about $300,000. Multiply that potentially by 2 individuals. you're looking at 600,000 in today's dollars. And if it's inflation adjusted, as one can determine, it's only going to go up from here, as long-term care tends to increase by about 5 to 7% per year historically, and more before that. So it's certainly a big liability on people's part.
Wow, that's a lot of money. As the insurance companies have gotten creative, though, around long-term care, can you provide the various types of policies that are available?
Sure. So I guess before we just talk around the types of policies, I mean, from our experience and when we speak with our clients, there's sort of, if you will, 4 types of people that look at long-term care, and at least the results of that. There are those people that just completely do not believe in long-term care. There are ones that feel that buying a long-term care policy, again, mitigates some of that risk. There are others that what they feel is that eventually they're going to spend down their assets and they will have Medicaid take care of them or potentially their family, right? So that's the big unknown.
Mm-hmm.
And clearly for us, when we're planning, it's about quality of care, clearly. And then there are those that feel that they can self-insure. And as much as depending on someone's net worth, and if someone can insure themselves, we still feel that looking at the long-term care part of it, as far as the insurance, still may make sense. You don't necessarily have to take out the best policy, but again, people that have done insurance before understand the implication of having it and looking at it from a longer-term point of view, and again, giving that risk to the overall insurance company. So the types of policies that are out there, sorry, just to answer the question, there are many, and the insurance company has gotten very creative, if you will, to try to solve for a lot of these solutions. If you take a snapshot back, interestingly enough, back in 2000, there were about 120 different long-term care companies. Currently, there are about 15. And the rationale behind that is because a lot of these companies are out of business and they completely mispriced long-term care. But so one potential option is just to take out a standard long-term care policy. We basically price out based upon need. Let's assume we do a 3-year need for $300,000 and it's $100,000 per year. Then based on their medicals, we will they will pay a certain premium. It could range $3,000, $4,000, a couple could be $6,000, $7,000, again, depending on the underwriting process. And they would pay that until they need those funds. So they would basically pay that until those funds would be utilized. The other policy is sort of a hybrid kind of a scenario. And here, what you do is you give an insurance company a lump sum of money. Let's just say it's $100,000. They then give you a multiple of that. And again, let's just say it's 3 times that for $300,000 of a benefit to utilize whenever you want to use that long-term care policy.
I see.
The beauty of these types of policies is that the one question, or at least one concern that many clients have is, hey, look, I want to pay for this, but what if I don't use it? What will then happen? This is almost a cleaner type of saying, well, if you don't use the $100,000 that you put into this account, those funds will come back to you whenever you need them or want them if they are not used for long-term care. So think of it as a checking account. I hate using that analogy, but to a certain point, it is that it's money sitting there readily available when you need it. It does not collect any interest. And it's built sort of on a chassis of a life insurance policy. So there is life insurance component to it. But again, it solves the need of if and when clients want their money back, they get that money back.
Okay, now let's suppose that I need it. I put the $100,000 in, and now I'm in need of the care. Does that $100,000 spin off into additional coverage, or do I need to supplement it later on when I need the care?
Yeah, so the way it works is that if let's just say, for instance, you take this policy out 5 years ago, and now all of a sudden you put $100,000 in it, now you have a $300,000 amount. Well, let's just say you then take $50,000 of that. Okay, now it takes away from that $300,000. It minimizes it to $250,000, but that $100,000 now becomes $50,000. So The way the insurance
Right.
company basically structures it is that you have this bucket of assets. If you draw down 100,000 for the need of long-term care, then it draws down that 100,000 that you initially put in. And conversely, if you take the 100,000 out, all of it does disappear. Now, if you need more,
Right.
that's another option to think about doing another policy or something.
Okay. Now, as we go through these policies, do they still have the kinds of long-term policies when these first came out where you made a payment every month, kind of like life insurance? And are those level policies? Are those costs the same every month? Do they increase or are they variables?
Yeah, no, the whole industry has gone through a significant change, and
Yeah.
as I sort of stated before, a lot of the insurance company mispriced this, and
Mhm.
they mispriced it negatively. So to your point, the initial policy that I mentioned, which is almost like a life insurance policy to a certain extent,
Right.
where you pay a certain amount per month, or every 6 months, or every quarter, and that may change. So we've had experiences where, let's just say, company X mispriced it. They go back to the consumer and they give them one of two options. They could say, well, you were paying $3,000 per year for a $300,000 benefit, and now all of a sudden, well, based upon our inability to pay that, we're going to give you two options. It's either A, you pay $4,000 now a year, or instead of having a $300,000 benefit, we're going to decrease that to $250,000. So that's what we've seen. Now, the one other policy which I'll just mention, which I did, is and to your point around the insurance part, life insurance, they do have a type of a combination life insurance policy with a rider of long-term care. So just to keep it high level and relatively simple, the way it would work is as such. Let's just say you take $1 million life insurance policy out, okay?
Sure.
And with a rider of long-term care. Well, if all of a sudden, fast forward 20 years from now, you need long-term care, you could use a portion of the proceeds from the death benefit to pay for the long-term care. It just decreases the death benefit. So again, it's something different. It's something creative. It fits in certain instances when somebody needs insurance, as far as life insurance, and also long-term care. So it's a unique way of doing two things.
That makes sense. I remind people, you're listening to Westchester Talk Radio. You're also watching Westchester Talk Radio. And we once again are with our friends at Hightower of Westchester. And Roman Chostik is with us. He's the managing director and partner. And we move forward. Is long-term care expensive in general? I guess we can conclude that.
Yeah, it certainly is. As I sort of mentioned, I mean, depending on where one lives, it certainly can be, and it can impact one's overall financial plan. Now, there are a lot of moving parts when you look at taking out insurance, and one of them is obviously there's an underwriting process of the insurance in majority of the cases when you're looking at long-term. So that may ultimately determine as to how much the premium will be per year based upon your health category, right? And as we all know, as people tend to age, it's extremely difficult, or has been more to come out preferred with circumstances. So again, it's based upon that. But then there are discounts if you take out a joint policy with your spouse. In the state of New York, there is a deduction that you could get over a certain amount of adjusted gross income. But it certainly fits into the overall process. I mean, the one thing we tell clients is that, you got to take a step back, look at your budget, and look what you can afford, right? It's not that you need to take out the Cadillac policy, but if all of a sudden, instead of paying, let's just say $4,000 a year, you could only afford to pay $2,000. Well, let's reduce that benefit every single year to maybe a certain amount, or we basically don't include an inflation rider, for instance, or as far as when the need comes about, there's a deductible of a certain amount of days. So again, there are ways of doing this. I mean, the one part I think that people get caught up on is when they think of long-term care, the misconception out there is that they think that they're going into a facility, or that their kids are going to put them in a facility and that's it and they're done. That was then at least the mindset, but currently people want to be home. People want to stay home. They want to have care at home. And again, for us, majority of the people, that's the route or direction they take. But once they cannot, then then obviously you have to sort of take that other phase of the long-term care piece of it. And you know, look, in this world right now, as seems sort of a black eye around this whole thing with a lot of these facilities and with the virus, things of that nature. So I want to say a lot of these insurance companies, or at least a lot of these facilities, are pivoting, and I think it's to be determined as to how this will ultimately look. But there's still going to be a need.
There is going to be a need, and I think you've emphasized as well, perhaps for home care as opposed to care in a facility. Let's move on. None of these really work. Well, they do, but they need to be complemented if you have a true estate plan with life insurance. Let's talk about that and how it works with long-term care and with the preservation of assets.
Yeah. So you know, life insurance, again, in the planning process is a critical part, right? It's to sort of offset some of the liabilities that people have, whether it's mortgage, paying for their kids' education, making sure your spouse is taken care of, right? So it fits those needs, and then it certainly also fits the estate planning part. And this is the moving target. We don't know what that will look like this year, 2021, or beyond that, right? Are we still going to have that $11 million plus exclusion, or will that look different? So it's something that we have to reassess. So there are, let's just to kind of keep it high level, of various different types of insurances. You have your traditional term insurance policy. It could be 10, 15, 20, 30 years. I want to say think of it like a mortgage, but think of it in those sort of terms where at a certain point it will expire. There is no cash value built into it. It's a term policy. So it fulfills a specific need for a particular liability over a certain time frame. So it's sort of a lower expense, if you will, as opposed to having a permanent policy. The whole life policies are permanent policies where they have a lifelong coverage, and the majority of the cases, I mean, if not almost all, they build cash value as well. It could be, but these particular policies tend to be a little bit more expensive, and it's good for the individual that wants to really have a forced savings account, because it's a way to really put cash in there. You have some universal life policies, which again is another permanent policy. You have some more flexibility here. It does build a little bit of cash value, but it has the ability to have some, again, more functionality around flexibility. And then there's a variable universal life policy, which it's comparable to the universal life. It's just that there's a separate bucket there, which gives you the ability to get an enhanced level of return on the cash that's in there, perhaps invested in the market or things of that nature. And lastly, what we look at is just disability. And this is really just a part where you replace your monthly income if there's a specific injury or illness that prevents you from working. And you know, the one part that we do see is that people they have disability through work, but at times it's not enough. So we try to complement all of that on our end.
You know, Roman, before we wrap it up, when I hear you talk about long-term care insurance and life insurance and the different variables of all, even home-term care, disability insurance, how important is it for people when they look at these things to look at the totality of their assets, the totality of their investments and their estate plans? Can you wrap that into one vision for people?
Yeah. It's always a moving target, right? Because every situation is different. And, you know, what we try to do with the majority of our clients is really bring everybody to the table, because you can't really have the estate planning, the financial planning part work, right? We try to help kind of become that CFO, if you will, that chief financial officer, but we help quarterback the overall process, right? We need the accountant, we need the estate planner, we need the kids, your spouse, to understand specifically what you have, what the implication is for us from a tax standpoint may look like if it's not done correctly, right? Just to your point, perhaps you need to start create some irrevocable trusts where you put the insurance in that, and then ultimately those funds upon one's demise are out of your estate, right? So there are so many different nuances, and for us, as much as, you know, we're speaking in generalities here about the insurance piece of it, it's about putting the pieces together. And, you know, the one part, and I'll mention this, is you know, it's about really having the right team and really the the right people to sort of facilitate the overall process and keep it moving forward.
Any final comments?
Yeah, so I think the best way to make smart decisions is to go into the process armed with overall facts. How likely are you to need long-term care or any type of insurance, or for how long? What are the costs, whether it's long-term care or overall insurance, and what is the what is the overall cost on the whole process? And that is exactly what we try to provide, is just clarity, insight, and to have a broader dialogue and a discussion around all of this, right? Just to get everybody comfortable. And just to kind of sort of extrapolate that a little bit further is as much as we know about insurance, and our team does, and this is sort of the role that I play within the team, we are generalists, right? And we're pretty knowledgeable about what is happening in the industry. But when it comes to really laying the groundwork and taking this to a deeper dive, we really contact an agency that we deal with, and there's a specific insurance agent that deals with us, and they basically look at your underwriting process. They come up with the recommendations around, from the estate planning part of it, as to which insurance will make sense, right? Whether it's the life insurance or what long-term care process or product or investment vehicle may make sense. So again, it's more of the dialogue behind it, and it becomes a level of making sure we all understand as to where we're going. And just lastly, if I could, just insurance, just like many other things in estate planning, as you mentioned, it's not about you're done with it and then you just never look at it. Nobody really wants, just like estate planning, it's something that needs to be reviewed constantly. We all need to kind of look at it. Tax laws change, people's circumstances change, estate law change, etc. So for us, we need to take a step back always and reassess every couple of years or a year, depending on circumstances change, if it's still the right policy.
Okay, Roman Chosik, Managing Director and Partner at Hightower. Once again, I thank you very much. This information is valuable. And thank you very, very much for being with us today.
Thank you, Bob. As always, appreciate it.
It's a pleasure. Thank you, sir.
Hightower Westchester is a group of investment professionals registered with Hightower Securities LLC, member FINRA and SIPC, and with Hightower Advisors LLC, a registered investment advisor with the SEC. Securities are offered through Hightower Securities LLC. Advisory services are offered through Hightower Advisors LLC. This is not an offer to buy or sell securities. No investment process is free of risk, and there is no guarantee that the investment process or the investment opportunities referenced herein will be profitable. Past performance is not indicative of current or future performance and is not a guarantee. The investment opportunities referenced herein may not be suitable for all investors. All data and information referenced herein are from sources believed to be reliable. Any opinions, news, research, analyses, prices, or other information contained in this research is provided as a general market commentary. It does not constitute investment advice. Hightower Westchester and Hightower shall not in any way be liable for claims and make no expressed or implied representations or warranties as to the accuracy or completeness of the data and other information, or for statements or errors contained in or omissions from the obtained data and information referenced herein. The data and information are provided as of the date referenced. Such data and information are subject to change without notice. This podcast was created for informational purposes only. The opinions expressed are solely those of Hightower Westchester and do not represent those of Hightower Advisors LLC or any of its affiliates. Hightower Advisors do not provide tax or legal advice. This material was not intended or written to be used or presented to any entity as tax advice or tax information. Tax laws vary based on the client's individual circumstances and can change at any time without notice. Clients are urged to consult their tax or legal advisor before establishing a retirement plan.